Uber was easily the most anticipated IPO of 2019. They revolutionized the taxi industry with their marketplace app that connected buyers and sellers of transportation services. Since Uber was founded in 2009, we've seen countless companies try to recreate their business model, but applying it to different industries. And as such, we've seen Uber reach a level of fame that very few companies have been able to replicate in the last decade. And with this fame has came an extremely large price tag for the Uber business. Now, while Uber has seen tremendous growth in their revenues and user base, this doesn't necessarily make them a great long-term investment. And that's why in this video, I'm going to be giving you guys 5 reasons why Uber makes a bad long-term investment. Now, you guys should stick throughout the whole video because I think you're going to find some of the analysis I did very interesting. However, if you're not interested in sticking throughout the entire video, then you can skip all the way to the end where I'm just going to be summarizing the 5 reasons why Uber isn't a great investment. How's it going, guys? My name's Aaron. I'm a value investor and trader. Welcome back to my channel. As always, I'm not a financial advisor. These videos are purely for entertainment and education purposes. You should always be doing your own due diligence in order to make an informed investment decision. However, I do hope that you guys find these videos entertaining. Now, if you enjoy this video, please like and subscribe so that I know to keep making more videos like this in the future. Now, with that, let's get right into it and talk about the first reason why Uber is a bad long-term investment. The first is that they're currently subsidizing riders with investor money in order to drive out competition. Now, this made a lot of sense when they were being funded by venture capital because venture capital actually doesn't care about the operating results of the businesses they invest in. They just want to see massive top-line growth. Now, when you look at the funding history of Uber, they've raised over $23 billion, and this has allowed them to drive out competition by continually losing money. And you can even see, even though they haven't turned a profit since their inception, their valuation continued to climb at an exponential pace, and even today, their current market capitalization is $64 billion. Now, the way that venture capital firms work is that they pump the companies they invest in with a bunch of cash, and they tell them to go grow as quick as they can. This is why you've seen Uber expand all over the globe in just a few years, because they've been given so much cash, and venture capital firms expect extremely large returns for their invested capital. Now, once the venture capital firms feel that the company has maxed out its potential, they unload their overpriced shares on the general market, and this is what happened in 2019 when Uber IPO'd at an exceptionally high market cap, while the original investors from the venture capital funds dumped their shares on the unsuspecting retail market for an incredibly large profit. And even though Uber is now a publicly traded company, they're still operating as if they're a privately funded company and generating massive quarterly losses. Now, this is a great segue into the second reason why Uber is a bad long-term investment, and that's that they have poor operating results with an unclear path to profitability. Now, if you take a look at this graph, the orange line represents their cost of sales, the blue line is their revenues, the gray line is their operating costs, and the yellow line is their total costs. Now, for Uber to break even, the blue line is going to have to cross the yellow line. And if you take a look at the difference between the revenues and their cost of sales, you see that the gap is widening, which means that the company is experiencing some sort of economies of scale. And while this is a good sign in terms of their ability to reach profitability in the future, if you take a look at their operating costs, they exceed their revenues. So there's no way that they're going to be able to be profitable if their operating costs are going to remain at this high level. And now this goes back to the first point of how they're subsidizing their riders using investors' money. And this is where this high operating cost is coming from, because they're reducing the cost for the riders by providing a bunch of promotions and sales in order to drive out competition and not create a market for anybody else to come in. And that's a bad sign for investors because it means that the company is not going to be able to remain operational unless they continually dilute their shareholders or turn to the capital markets to raise a bunch of debt. Now, in order to see how dramatic of a change the business would have to undergo just to reach break even, I made a break even analysis of the company's operational results all the way into 2023. So there's 3 key assumptions that I made through this break-even analysis that you should know because it shows how unlikely it is that the company is going to be able to break even by 2023. Now, the first assumption I made is in terms of the revenues. In 2020, I reduced revenues due to the current coronavirus impact that we're seeing right now. But after that, I maintained a growth rate of 20% because that's a growth rate that the company experienced from 2018 to 2019. The second is that I said that they are not going to increase their operational costs from 2019 all the way through to 2023, which obviously is not realistic. But this just goes to show of how dramatic of a change the company would have to undergo in order to reach break even. And third, I made the economies of scale between their revenues and their cost of sales reduced from 50% cost of sales to revenue all the way down to 30%. So this means that the company would have to experience very significant economies of scale across their business lines. And while this might be possible, there's no research to back up that this is actually going to happen. However, these are the 3 conditions that are necessary for the company to be able to break even just by 2023. So that shows you just how poor of a position the company is in right now and how poorly they've been set up by the venture capital firms in order to reach profitability in the future. Now, the next point we're going to look at is that the company operates within a commodity industry. However, they're being priced by the market as if they're a monopoly or a duopoly. Now, there are 5 key attributes that you can use to identify a perfectly competitive market. The first is that the product or service is near identical. Now, Uber is in the business of taking a person from point A to point B. And while it might be a little bit different whether you're in a taxi or in somebody's car, at the end of the day, what the business is taking a person from point A to point B, and whether that's in a taxi or in somebody's car, the difference isn't that big. The second is that the market is made up of a lot of buyers and a lot of sellers. Now, we already know that there's a lot of buyers who need to travel from point A to point B every single day, and there's also a lot of sellers. Now, Uber not only has to compete with competitors like Lyft, but they're also competing against the taxi industry as well. And all of the sellers within this market are competing on price. And that leads into the third point, in that competitors are only able to compete on price. And while in the short run, if Uber were to increase their price, maybe consumers might stay with Uber for a little bit. In the long run, what consumers really care about is how much they're paying to get from point A to point B. While the service does matter in the long run, the most important factor is the price. Fourth, there's few and small barriers to entry. Now, to replicate a business like Uber on the international scale that Uber has, of course, the barriers to entry for something like that are massive. However, to compete with Uber just on a local level, the costs are actually not that high. To build an app similar to Uber, it's actually not very expensive. You can get it done for anywhere from $50,000 to $200,000. Now, after that, what you need to focus on is gathering enough drivers to attract customers, which at the end of the day isn't going to be that expensive if you're doing it just on a local level. So for that reason, the barriers to entry to compete with Uber on a local level are relatively small. However, if you're going to compete with them on an international level, they are relatively high. Fifth, sellers have no market pricing power. Now, this is very important because if you're in a monopoly or duopoly, you're able to control the price however you want. However, Uber isn't able to exert any sort of market pricing power, because if they would, then their competitors will come out with a lower price, and then Uber's market share would slowly erode. So for that reason, the sellers have no market pricing power, and they're actually price takers. Now, to get an idea of how competitive the industry is, I'm going to show you guys some of Uber's top competitors internationally. Now, Uber has 103 million users, 3.9 million drivers, and they operate in over 600 cities. Now, Lyft is Uber's largest US competitor. They have 21 million users, 1.4 million drivers, and they also operate in over 600 cities. Now, Uber and Lyft are identical, and actually Lyft has better overall customer reviews than Uber. Next, Uber faces competition in India from Ola. Now, Ola is actually interesting because they don't operate the same as Uber. They actually aggregate every type of transportation service onto one app. So you can get everything from a motorcycle taxi to car rentals on the Ola app, which gives users more variety and allows them to bring on more business than what Uber would be able to do. Now, a business similar to Ola is actually what I believe is going to be the future of the industry, where you aggregate all of the customers' options onto one platform, and then the customer is able to choose between what option fits their needs the best. In addition to that, Ola has more users than Uber, with 125 million users, 1 million drivers, and they operate in over 100 cities. Now, Ola is limited just to the Indian market. However, because of the fact that they aggregate all of the users onto one app, Uber won't be able to compete with them within the Indian market. Next, we have Bolt, who is Uber's European competitor. They have 30 million users, over 500,000 drivers, and they operate in over 150 cities. Now, the advantage that Bolt has over Uber is that the taxi industry is heavily regulated, and when it comes to regulations, a foreign company is going to be viewed much less favorably by the legislators than a company that is from the EU. And so for that reason, Bolt is likely going to be able to navigate the regulatory environment much better than Uber. Next, we have Didi, which is Uber's Chinese competitor. They have over 450 million users, 21 million drivers, and they operate in over 400 cities. So Didi absolutely dwarfs Uber in terms of users and drivers. And actually, Uber recently sold their Chinese business to Didi, and they currently have a small stake in Didi. However, because of the size of Didi, Uber will never be able to compete within the Chinese market. Next, we have Uber's Latin American competitor, which is Cabify, which is by far the smallest out of all of their competitors. They have only 600,000 users, 200,000 drivers, and they operate in 100 plus cities. However, they are seeing very tremendous growth in their business lines, and they're very focused on the Latin American market, and they do actually have a lot of trust from their consumers within the Latin American market compared to Uber. So looking at all these, we see that Uber is actually facing a lot of competition around the world, and likely what's going to happen is that Uber is going to have to divest from most of their international markets in order to focus on the North American market. So now moving forward, the fourth reason why Uber is not a great investment is because they have network effects, but they're relatively weak and easily replicated. Now, there's three reasons why they're relatively weak. The first is that they have low switching costs. It costs almost nothing for a user to go from Uber to Lyft. All they have to do is download the app, make a profile, and they're good to go. Second, Uber and Lyft have identical services. And actually, Lyft has better reviews. So what this does is that if there's ever a time when there's not enough Uber drivers, then the consumer will very quickly shift over to Lyft. And maybe they'll become lifetime Lyft users because the reviews are a little bit better than Uber. And at the end of the day, they're the exact same service, so why not go for the one that you had a better experience with? Third, there's lots of substitutes to the Uber business. You can take a taxi, you can bus, you can walk, you can get your friends to pick you up if you want. So for that reason, there's not that much keeping users within the Uber ecosystem. Now, when you compare the network effects of Uber to that of something like Facebook, you can see why Facebook has much stronger network effects. For Facebook, their switching cost is very high because you have all of your friends on there, you have all of your photos, and it would be very challenging to move everything to another platform. Second, there's nothing that really compares to Facebook. So for that reason, consumers don't really have the option to move out of Facebook onto something else. And finally, Facebook actually has a virtuous cycle that brings users in because a new user added makes Facebook more useful for another user. So for that reason, they have an iterative cycle of users coming into their platform, and also with more users comes more advertisers. So for that reason, Facebook's network effects are much stronger compared to something like Uber. Now finally, the company has a laundry list of potential risk factors. I've never seen a risk section as long as Uber's on a company's 10K. They had 33 pages of risks versus a company like Apple who had just 10 pages. Now, Apple is an international company that faces many risks from major competitors like Google and Microsoft. However, their risk section was still only a third of that of Uber, which just tells you how risky the Uber business is and how risky even management acknowledges that the Uber business is. So while I could spend hours talking about each of the risk factors, there's two main risk factors that I find are the most important to watch out for Uber. The first is that autonomous vehicles pose a significant risk to the long-term success of their business model. Now you have companies like Tesla, Google, and Amazon all competing on creating autonomous vehicles. And once these autonomous vehicles come out, there's not going to be any more need for the drivers that are on Uber. And these companies are going to be able to replicate the Uber model, except without drivers. Now, once this happens, Uber's market share is going to take a massive hit. So this is something that's a very big risk for Uber long term, and it's going to make it very challenging for them to compete. And the next one is that reputational damage happens very easily, and it's not contained to one specific area. So we've even seen that when Uber has a negative incident in UK, you hear about it here in Canada or in the US. So for that reason, that any reputational damage that Uber takes on is going to be felt around the world. And that's a major risk for the company because they're not going to be able to mitigate any damages. And since they are just a marketplace, it's very hard to control what happens with their users and with their drivers. So in summary, the 5 reasons why Uber makes a poor investment is because they subsidize their riders with investors' money. This is the venture capital model, and it's what allowed Uber to grow so quickly and become the major company that it is today. However, it's terrible as a long-term investor because it means the company is constantly running an operational loss. And that leads me right into the second point, which is that they have poor operating results. And as you saw with our break-even analysis, the company would have to take very dramatic steps in order to reach break-even just by 2023. The third is that Uber operates within a commodity business, but it's priced as a monopoly. Uber is within the business of taking a customer from point A to point B, and whether you're in a taxi or somebody's personal car, at the end of the day, what the consumer wants is to be taken from point A to point B safely. Fourth, they have relatively weak network effects when you compare them to a company like Facebook. And last, they face a laundry list of potential risks and future headwinds to the business. So that does it for this video. I hope you guys found this useful. And if you don't agree with anything I said in this video, I would love for you guys to drop it in the comments below so we can start a discussion. Now, as I said earlier, I'm not a financial advisor. You should always be doing your own due diligence when making an investment decision. However, I hope you guys found this video enjoyable, and I look forward to making my next video for you guys. Have a great week.